My name is David Cruijff. I represent CGAP, and today we're here to talk about data-driven investments. But before we get to the point, I'm going to explain to you why we're going to talk about data-driven investments. And there's a row of very brilliant people there. We'll get to them in a bit. There's a thing here. Let's see. There we go. Just look at the slide, and let me tell you that there are nearly 500 million micro and small enterprises in emerging markets and developing economies. And these MSEs account for nearly all firms and for most of the jobs in these countries, and MSEs are critical for the livelihoods of people living in poverty. And as you'll see on this chart, which is produced by the ILO, you'll see that these different colored bars, they represent the employment share of firms by size based on the number of employees. And the smallest firms are the sole proprietorships, and the ones next to it is from 2 to 9 employees. So generally speaking, firms from 0 to 9 employees are considered microenterprises. And if you look good at this chart, you'll see that microenterprises absorb anywhere between the 80 and the 90% of employment in low-income and lower middle-income countries. But despite their importance, MSEs continue to struggle, because MSEs, like any business, MSEs need access to financial services, and specifically they need access to credit. And that's critical, not just only for the growth, but also just to be sustainable and to have some resilience against shocks. And we've used Dahlberg estimates to estimate this credit gap. Dahlberg estimated at $4.9 trillion. And there's a lot of issues with how these estimates are being made, but it doesn't really matter if it's 5 trillion, it might be 7 trillion, maybe it's 2 trillion, it doesn't matter. What matters is that it's a really big amount. Now, at CGAP, we really believe in the potential of inclusive fintech models, especially those fintech models that combine a high-tech with a high-touch approach. What I mean by that is those models that, next to the technology that they use, they have feet on the street, they have officers, loan officers, physical touch points, serving clients on the streets and onboarding new ones, and that's crucial. And in this slide, you can see a handful of selected measurement points that we took from pilot projects that we ran with these fintechs. And these fintechs, they all have different business models, but they all target the same excluded or underserved MSEs. And we really see impact. And not only impact like, yeah, the sales and the revenues increased and all that, and that's great, but also the percentage of MSEs accessing these services for the first time, or the overall resilience that they reported, and the quality of life that they say has improved. So, there is real impact going on. But despite this impact, fintechs continue to struggle. And fintechs, almost all early stage inclusive credit fintechs have the same struggle, and that is accessing funding, getting the right investors to work with them. Now, investors, they often shy away from early stage fintechs. They do that because there's a lack of track record, and the balance sheet strength of the traditional fintechs is not the same as the balance sheet that traditional financial service providers can show. And the capital base of fintechs is small, usually pieced together from family and friends, some grants, some early venture money, and their business models, they're unfamiliar to traditional investors, and they're rather opaque sometimes also. So this has real consequences. These fintechs operate with limited and costly capital, forcing them into a constant fundraising cycle just to sustain operations. And many ultimately are just unable to scale, leading them to either wind down altogether or move up market, serving larger, less excluded clients. When we look at the capital structure, sorry, I'm going too fast. When we look at the capital structure of fintechs, equity remains the dominant source of funding. And of that equity, it's mainly venture capital that really plays a dominant role throughout all the stages of a fintech's life cycle still. And we can fairly say that the absence of sufficient debt funding is a major bottleneck. And without access to scalable, affordable debt, fintechs struggle to grow sustainably. So they can pilot, but they can't scale, and that's a real issue. How big is this issue? Well, the data here shows how tough and how real this problem is. I mean, we've done research together with Brighter Bridges and DFS Lab, looking at the investment flows. And this research shows that more of half of the inclusive credit fintechs never make it past their first funding round. And even more shockingly, only about 15% go beyond the third funding round. So So that's how difficult it is. It typically also takes around 2 years for a fintech to secure their first disclosed investment. And during that period, most fintechs are bootstrapped with short run rates. So many simply don't survive, and those that do often move up market. So, the current funding landscape not only limits growth, but it also pushes fintechs away from their inclusion mission. And this is the problem that we're dealing with. Luckily, we're not dealing with this problem alone. Luckily, we have some smart new asset managers, a handful, and they're tackling this problem head on. And what they do is through data integration to transaction level and portfolio data, they gain real-time visibility to cash flows, client repayment, and portfolio quality. Insights that go far beyond what static financial and operation reports can offer. So these innovations are expanding the type of investments products available. More specifically, they enable early stage debt investments to inclusive credit fintechs. Also, and this you will hear from all these people sitting next to me, these data integration and analytics thereof produce advanced risk management models that allow asset managers to better understand and detect risk. So these investments are powered by proprietary analytic platforms that turn a lot of this granular data into data points into decision-ready insights. But to be clear, this doesn't replace the traditional common sense investing. Each of these asset managers, they all have regional offices, they all have investment officers that still look under the hood, they still visit the fintechs, they build relationships, and they're validating what's happening on the ground. The data simply complements that understanding, enabling a faster and evidence-based decision-making. So data integration allows asset managers to say yes to opportunities that might look too early or too risky for others, and equally important to say no when the data doesn't validate what is being reported. So, and on the monitoring side, the data feeds make it possible to track operational performance in real time. That means automated covenant checks, spotting transactional anomalies, and uncovering fraud way ahead of what traditional monthly or quarterly reporting will show you. So ultimately, these people here, these data-driven investment firms, they're bridging a critical credit gap, as you can see in the slide, in emerging markets and the developing economies. And not only do they fill this gap, these asset managers, they help these fintechs really mature into more investment-ready, more mature fintechs. So ultimately, in that sense, they are building the very pipeline for many of you investors in this room. Now, the rest of the next part of this panel we'll hand over to the asset managers. They will present their company, and they will present a use case of how they use data to do something which traditional investors would not have picked up on or would have not have done. So let's start with Alma. Aditya Talang from Alma. The floor is yours.
Thank you, David. Hi, I'm Aditya. I'm from Alma Sustainable Finance. Our firm we are a $250 million private credit fund, which focuses exclusively on fintechs in emerging markets. Now, when we say fintechs in this context, we refer to fintechs that offer credit. There are payments, there are other fintechs, but our focus is hyper-specialized to credit offering fintechs. Our firm offers senior secured loans that allow these fintechs to grow their loan portfolio. Our firm was created by 3 fintech entrepreneurs who set up their own fintechs and operated their own fintechs and realized that in scaling their companies, they lacked access to credit. And fintech at the end of the day is a form of lending, and you need debt to offer debt. And so the lack of wholesale debt markets are what created the constraint which emerged as Alma Sustainable Finance today. Now our approach, I'll talk a bit about what we do. We are able to use all data that is available to fintech lenders. We realize and we believe that fintech lenders are emerging in every emerging market. Venture capital has helped in building scale and helping them set up credit evaluation engines to serve very specific, very unique needs in each local market. But to scale that, we have a role to play as providers of credit. The second area is local debt capital markets are very shallow in some of these markets. So you have excellent lending companies offering products at the retail level, but they don't have access to debt capital markets themselves, and that's the role that we play in. Now, in these markets, our approach is we use all data that's available. This includes transaction data, this includes loan tape data, this includes anything that a fintech collects is also something which we use to underwrite that company. And we have belief in our approach, and we express that belief by taking a first loss tranche from our personal capital in every pool that we raise. And we also don't charge any fees. We rely only on the spreads. That shows the belief that we have in the approach that we are using. And what we act as our partners in the journey of fintechs from a very early stage until they can scale large enough to get access to more formal, larger pools of debt capital, either locally or globally. That's a bit about us. Perhaps in the next slide, I'll talk about one use case which illustrates what we do, which is different from other lenders. Here, this example is of a company that we were evaluating, and this will cover how we use data at the diligence stage. Some of the other examples will be post-diligence, so you'll get to see a good spread of how this data can be used for more effective underwriting. We were speaking with, we were in talks with a vehicle and SME finance company. The way to understand this company is they had really cracked how to repossess and resell vehicles in each market. That was their core competence, which they used to identify multiple use cases and across multiple countries. And so they ended up with creating 5 products across 6 countries in order to build scale. Each of these markets were relatively small markets, but as a whole, the company became large enough to raise debt and equity capital. Now, for this company, each country we worked through multiple LMS systems, multiple sources of data, and we were able to patch together what is happening for each product in each country. And our findings, as with every due diligence, there are a lot of findings, but I'm going to focus on just one finding, which is the quality of underwriting and the predictability of credit outcomes for each product in each country varied. Some products did well in some countries, and there was a very high variability in the returns, cash returns from loan portfolios in some others. This is what the data showed. Then we step out of what data can give us and move to the structuring phase, to using this data to mitigate risk. And what we did was we separated their country and product mixes. So product 1 in country 1, product 2 in country 1, and so on. And we classified these into 2 types. One are established products with a very predictable return profile with low volatility, and the other are experimental products. As with any company, there are new products being launched which are not yet established. And using this, we chose to underwrite the ones which were established while allowing the company and creating room within our terms for the company to still build out the experimental products and create incentives for bringing those experimental products into our fold once they become established. This is an example of how we were able to do this with using data which is much more than the traditional management accounts and audited financials. And yeah, this is an example of this approach at an underwriting stage. Over to you,
Thank you,
David.
Alicia. Next example will come from Lendable, and Olivia Johnson will walk you through it.
Yes, hi everybody. I'm Olivia Johnson. I lead our analytics side at Lendable. Similar to Alma, we're a private credit debt provider in emerging markets. We also have advisory services using our proprietary platform, Maestro, which is a platform that integrates with our prospective borrowers and current borrowers' loan management systems, their CRM systems, so we can extract very similarly kind of the end transaction data to allow us to do our underwriting and to independently verify both the credit and the impact of these business models. And so we provide also generally senior secured debt facilities to emerging fintechs and sustainability companies across Africa, Southeast Asia, and Latin America. We also provide monitoring and verification services to other investors such as DFIs and institutional investors using our Maestro platform. And with this approach, we've been able to finance about 48 different companies. We've been able to deploy around $680 million with double-digit returns for our investors. And impact is also at the core of what we do. So we measure our success against SDG metrics, and we've so far reached over 5 million end borrowers through financial services and inclusive finance. And we also want to talk a bit about our approach of using data and give you kind of an idea of how we do this on a day-to-day. So I think I'll hop into the case already here. So here we were looking at a fintech that was providing SMEs with lending products. They had a factoring product and a longer-term loan product of about 1 year. And initially, when we did the assessment, we received their management reports, their presentations, everything looked good. They had audited financial statements showing positive returns. They even had an external credit rating. But when we finally did the integration and started getting access to all the cash flow data, our system highlighted that there was potentially additional credit risk that was not being seen from the outset. So we were seeing a lot of loans that were being refinanced or rolled over where the principal wasn't being repaid by the end customers, by the SMEs, but rather rolled into another loan. And in fact, we were seeing they weren't even collecting the interest nor the principal, and that completely changed their ability to take in cash flows and have a positive unit economic product. And so that put into question what they were provisioning on their balance sheet and their profitability, and our estimation from our credit model suggested that their losses could be up to 20%, completely undermining kind of the profitability that they were seeing. So when we started discussing this with their team and started looking into this a bit further, we noticed that this was happening across one of their longer loan-term products, and if we were to invest, our exposure would be on these products where we couldn't actually estimate the real credit risk. So you can see that in the charts above that they were having a larger exposure to these types of rolled products, and their repayments, the paid versus due that we were expecting to see as a return, was reducing over time. And we wouldn't really have been able to see this through aggregated data. We basically needed that level of payments so we could also verify that they were receiving that cash through third-party banking portals. And so by doing that type of verification and this type of analysis, we ended up deciding that this was too much of a risk for us to take in our facility, and their exposure to kind of individual customers and to these products was a bit too high for us. In addition, the gaps in their loan management system to being able to track this type of lending made it clear that they needed to work on a system side. So one of the benefits of having teams of engineers and analysts who basically understand the data, who understand how this underwriting is being done through software and data, allows us to have this deeper look under the hood of fintechs and how they use kind of digital tools to make their credit decisioning. And so ultimately this is a case to show that this allows us to go deeper, allows us to do verification independently, and allows us basically to select the winners in these markets and hopefully de-risk investments into fintechs in these emerging markets.
Thank you, Olivia. Next up is Azir Sognaba from Catalyze Finance.
Hi, everyone. Very happy to be here. Azir Sognaba here from Catalyze Finance. Catalyze is a private and impact credit fund that is Africa focused only. So our mandate is really to support tech-enabled companies on the African continent. We have a mission on closing the financial inclusion gap that we see on the continent and providing capital to tech-enabled businesses that are reaching companies, MSMEs, and consumers that are usually excluded from the traditional financial systems that banks and the like. And the way we reach out to those underrepresented segment is really working through intermediaries. And those intermediaries are tech-enabled companies that have built systems and processes to deploy capital that actually make an impact. So we've been around since 2021. We have deployed over $80 million of capital to many of those fintechs, and we have impacted over 200,000 consumers since 2024 and over 60,000 MSMEs. And our product, similar to Lendable and Alma, is a senior secured facility whereby we take the collateral from those tech-enabled companies to secure our position. And we are really tech-enabled ourselves, and that really allows us to underwrite and manage risk that otherwise banks and other traditional lenders are not able to do. So our process is involves a mix of traditional underwriting, right? So where you have to do your financial statement analysis, understand exactly the capital adequacy and a lot of stuff from those fintechs. But in addition to that, we need to have a good understanding of the performance of those loan portfolios, right? Because that ultimately is the security that we take. Compared to a bank will usually kind of require hard assets or cash, right, as collateral. We don't require that. We will be able to actually look at a loan portfolio, assign a value to that loan portfolio, and be able to lend against it. And in order to do that, we need to be really tech-enabled. So here, I will talk about a real-life example that we encounter, and this is on with a portfolio company that we're already invested in. So this is an example of how the tech enablement really allows us to actually mitigate, manage, and mitigate risk. So this is to a loan that we have with one fintech partner that is doing MSME loans in East Africa. So they are making very small loans to mom and pop shops. Really, that's how I really want to. I can explain that, right? Like it's small loans, like $200 to $5,000 in size. Really short-term loans, and they are tech-enabled. So basically, what happens is that they disburse using mobile money. They also kind of get recollected using money, but the model actually allows them to actually have some degrees of flexibility from their agents, right, that are actually acquiring customer to either adjust limits up and down depending on some circumstances. So we are integrated, right, into their core banking system, to the loan management system. We can calculate at any given point in time the collection rates, the DPDs on the overall portfolio. And in our monitoring, we noticed something that our tech, that only tech can actually understand, because we have access to granular level of data that can actually like compute those performance metrics on an aggregate, and also basically being able to dissect it many different ways. So when we look at the performance of the company, we didn't really know that there wasn't really a large dip in the overall performance, right? So the par levels were more or less in par with what they were historically, but our engine actually like picked up areas where there were unusual activities, right? So basically we were seeing loans that were being originated a little bit outside of like the credit policies, right? So basically they can only do loans that are up to like 2,000. Then we started seeing loans that are actually like a little bit higher than that. And we're starting to see like delays in repayment from some of those borrowers. And our system was able to kind of like dig deeper and actually being able to understand exactly where those anomalies were coming from. And actually it turns out that it was coming from a branch that was newly acquired, that they newly set up, and they had an agent there that was more or less kind of colluding with like borrowers, right? Basically kind of telling them how can they actually like work on to kind of game the system and get like a larger loan amount and then default on that later. And because of our tech, we're able to actually like identify that this issue was coming from an individual, and basically we alerted the company about like this issue, and what they were able to do was to kind of like conduct like an audit and being able to kind of like reduce the risk. So this was a leading indicator to something that was going to happen right later on, right? So they were able to kind of stop like origination from that agent and have proactive measures to recollect the funding that were made, the fraudulent funding that was made by this agent. And what we were able to do, kind of increasing our monitoring, was to actually embed a lot of aspects of the loan management, the credit policies, right, into our underwriting and our monitoring, and being able to even make that available to our borrower so that they can actually have like a better sense of credit. So this is one example, a real world example of how our technology was able to identify something that was going to become an issue rather than reacting after the fact.
Thank you, Azir. Very interesting how you detect fraud of your clients in their portfolio.
Yep.
Next, David Kleitrath will talk about Untapped, but David Kleitrath is actually managing partner of Multivis Capital, and he will explain what he's doing here himself.
Yeah, so I'm still currently head of investments at Untapped, and we have decided to actually split the fintech part from the investment management side. So with Untapped, we have been able to finance over $17 million in Africa. We've deployed that into around 60 companies in 16 countries, and we've done like over 90 disbursements. We take a different kind of position, so we believe that we are flexible, so we can do revenue-based financing, we can do term loans. We're trying to match basically the contract with the unlender. And what we do with Untapped, we also can do data integration onto the asset level. So we can see what the performance is of the motorcycle or the car that we've been financing to a very granular level. And what we're trying to do there is that we have basically a pilot facility as well as a commercial fund. And the pilot facility allows us to build that relationship, do the data integration. But that by itself is, of course, that's a lot of work. So a commercial fund is then needed to make it sure that we can operate sustainably. And I think where we play a little bit different from my colleagues here is that we're a little bit earlier, so we can do up to $5 million. So I need them, and they need me to basically provide them with pipeline. And I think similar to if we look at the data integration that we have, right, for the next slide, we basically do very similar things. And maybe just to give you an example here, so we're looking at a company that from the onset, you think that from a profitability perspective, they are doing well. But if you look at the late payments, you see actually that there's a significant increase in late payments. And because of how we've structured the deal, and we basically have been able to finance tranches of motorcycles, it doesn't mean that we're stop investing. It just means that we invest differently, right? So for the next slide, you can then see that once the late payments went up, we've also, what we saw was that basically we then decreased our disbursement amounts, which you can see here a little bit before 2022, because the other thing that we're tracking is the capital efficiency, right? So what we want to see is we give our companies funding, and how long will it take them to basically get assets on the ground and start generating revenue? Because any delay is actually a capital inefficiency. So besides all the other data integration that we also can do, like cohort analysis, I think this is another example of what data can do.
Okay, thank you, David. And that wraps it up in terms of the examples of how data is being used to detect risks, to decide on investment decisions and whatnot. We at CGAP, we really believe that fintechs are going to play a crucial role in closing the financial, or making the financial inclusion gap smaller. We still are highly positive about what the financial inclusion community and investment community has achieved so far, and they should by all means continue doing what they're doing. We're just highlighting this now because we believe that this is a piece missing in the financing value chain. And also, as said earlier, once these data-driven asset managers, if they can do what they can do, if they can scale themselves, they will provide the pipelines also for the more traditional investors. So it's a very complementary piece. Enough from me, enough from them. Now over to the audience. I'm sure you have loads of questions. So yeah, there we go. Mister.
My question is, my name is Reginald, myself from Tanzania, and my question is around choosing the country of investment. What kind of data do you actually use? Because listening to what you are saying, a lot of investment going to Africa, but I'm not sure if Tanzania is in Africa, because I haven't heard of this investment going there. But basically my question is, what sort of data would you need to decide which country to go before you decide on which company to invest?
Okay, thank you very much for the question. What type of data do you need? Well, who would like to have a stab at that first?
Sure, I can try. So we are actually hopefully very soon we'll be doing stuff in Tanzania. I think it's a market that's really ripe and for these types of investments. Actually, I think maybe some of us actually already have transactions there. But I think generally speaking, I think this applies to not only Tanzania but to all of the markets where we operate in. I think for most of, and I'll maybe speak for most of us here, I think for what we are trying to do to really work, right, I think payments, right, needs to be mostly digital, right? So basically, we are having a hard time working with players that actually disperse cash, right? Really cash, handing over to customer, and customer actually going back with cash. That makes the integration and actually being able to track payments and details tricky. So basically being able to kind of have access digital nature in terms of payments and repayment is something that's important. But also for the companies, they need to actually be able to also show that they have a good understanding really of underwriting and basically being able to disperse and collect money. And for that, they need to have a tech, right, that allows them to understand the performance of a cohort, right? So basically, how is any customer segment is actually in a position to borrow and repay. So that's very important, and the technology that really kind of goes with that. So that's basically what we are really looking forward to kind of working with companies.
Okay, anybody that wants to add on to that?
If I may add on to that. See, there are two decisions here. One is the choice of country, and the other is the choice of the fintech. The data that fintech companies generate it's not really dependent on the country. The operations, the models, there are a lot of similarities across countries. So where we use a lot of this data that we are talking about here is in choosing the right fintech. The choice of country, and we do have exposure in Tanzania, so we have exposures in multiple African markets, and the choice of country is more determined not by the data that the fintechs provide, but by the legal structures that we have to secure collateral. So if a fintech is operating in any country and we decide that this is the collateral that we'll take as underlying loans, our ideal is to create some form of a bankruptcy remote SPV. And so in each country, we'll try to understand if there is a pledge registry, if there is any, what kind of bankruptcy protections are present, how can an SPV be created. So the legal and structuring side is more of a factor in choosing the country. And when we make investments, generally we find fintechs from across Africa. Choosing the country is something which, or choosing how to handle the security and the legal side is something which we really work with in each country, and we have to customize it to the laws and what's available in each country.
Okay, thank you for commenting on that. We have 5 minutes left. I want to take as many questions as possible, so let's go ahead, please.
Sure. Good afternoon, everyone, and thank you very much to the panelists for a very interesting session. The crux of my question is really, sorry, my name is Ngari Muhindi from the ACF, and the crux of my question is really, do you believe in teaching old dogs new tricks? And that's really on the point of, have you tried, and has there been efforts made in working with traditional lenders and getting them to get their systems to the point where you're able to partner with them? And do you see a value add in undertaking that effort to get traditional banks to be at the level, or microfinance institutions at the level where they are able to onboard with you and work with you? Or is that really, you're going to focus on the fintechs and leave the traditional lenders to the legacy players?
That's a very interesting question. Are you afraid that the microfinance institutions are being left behind? So what can we do?
So I mean, I can answer that. So I don't think, at least for our perspective, we've been able to finance microfinance institutions as well, right? Especially if they're in Kenya, we're able to integrate with M-Pesa or with their other bank statements. So I think for us it's more about, do they have the systems themselves? And that depends per microfinance institution as well. I think there are some of them that are actually very advanced, and then for us it's very easy to integrate with them. And for some of them, they might even still use Excel. And I mean, I'm speaking for myself, but then that's something that we can't work with because we need that real-time data integration, right? So we do make investments in microfinance institutions. Banks, I think it's a little bit different of a quick question there.
Yeah,
Yeah.
but
And to add on to that, I mean, I think the MFI sector could obviously really benefit from adopting a lot of these technologies, and what we're hoping to do also by having kind of a view or an audited view of what the portfolios look like, that we could bring in other institutional investors. So for like our co-investors, we provide a level of monitoring of this data as well. We can even provide it as a service so that they can access, different pools of capital that maybe traditional investors are worried to invest in fintech because they don't really know how to assess the risk. We can come in by having like the view on their data as basically a cheaper version of an audit. And so if MFIs can start to adopt those practices, they can also benefit from that side of things. And I think that's an opportunity for TA as well. So we've seen various DFIs being very interested in helping us work with fintechs that maybe weren't quite tech-enabled enough to provide the integration and the data that we would require for our type of investment, but that we put together a bit of a kind of a toolkit of describing like the type of reporting that needs to be able to be tracked, so the disbursements, the repayments, the rescheduling, and how that all needs to be verified and validated. And by doing that, hopefully the rest of the industry can move towards a more data-driven approach to allow us all to more confidently invest in those types of businesses.
Great, thank you for that. Yes, please.
I have a question. My name is Hannah. Thank you for sharing the use case on credit. On financial services, have you used this for investments and insurance? And if so, what are the examples? Thank you.
I mean, we've used it for investments. I think with insurance, it's more of a question of product, to be honest, because I think we've all have gone through the same like iteration, as in like what is it that we want to be? Are we a fintech company, and that's why OnTap basically separated the business, or are we an investment management side, right? Because once you go down the rabbit hole, there's a lot of that you can basically say, okay, with the data we can do insurance, we can basically start doing payment integration, right? And I think you need to be focused, and otherwise you will be all over the place.
Yeah, like the way we've expanded a bit at Lendable, we're doing sustainability, so validating carbon offsets. We think we can use similar approaches of data to understand, like say, carbon credits, and validating that these are actually valid and sufficient. And so I think insurance is another area where the use of data can help de-risk that and understand the business model. So it's not something Lendable has actually been focused on, but I think it's an interesting use case.
Within lending, we have there's a lot of opportunity. So I think at this point, it's important for us to be focused, but in the long term, perhaps we can consider how this can be used for insurance, but not today.
Okay, thank you. Now that bell that you hear the whole time means that we still have half an hour and we could take 100 questions. But I'm getting hungry, so I still want to make sure that there's still lunch. I'm going to give the last question to myself, actually. And of course, you can ask what you want after the panel to everybody. But what I'm interested to hear from everybody very briefly, give me the main reason why a fintech actually wants to work with you. Let's start with Olivia and work our way down.
Yeah, I mean, it's true that the upfront cost for the fintech is high to work with a data-driven asset manager like us. They need to put resourcing to integrate with us and to explain their data, to work with our analysts. But ultimately, that upfront cost is worth it because later on there's, I think, quicker deployment. We can very quickly assess a new product, a new geography, decide upsizing or extensions based on this data. And so we can be a very active kind of participant in their fundraising journey. And I think that's kind of the thing they really value.
For us, because we interact and we work a lot with technology, it gives us a common language to really understand the nuances of what the fintech is doing and have more nuanced conversations about how to use their data, how they are using their data, and to what extent can we infer and make conclusions from data. Fintechs don't engage, or lenders don't engage with fintechs at that level. And so that shared understanding of what they are doing and making sure that things are right, that's something which a lot of fintechs appreciate, that they don't get with other lenders.
Yes, for me, I would say it's flexibility and speed. I think because we have a good understanding of the data, that means that we understand their business very well. And because we're doing debt, debt can be as structured as you want it to be. So you can always find a solution that's going to work for any types of company. So I think that is a very big value add. And also because of that data, we can actually move relatively fast compared to a traditional lender, and being able to be very flexible in managing risk from our standpoint, and also being able to help that company keep going.
Thank you.
Yeah, and Azar stole my 2 points, so there was also speed and flexibility. But I think because we're playing a little bit on the earlier side, we can also do different kinds of structuring and approaches. So that's another reason why they like to work with us, at least.
Okay, well, we'd like to thank AFSIC for the opportunity, and we'd like to thank these asset managers for showing you what the future looked like.